Happy Friday. Thanks very much for being with us. What do you think? Obviously, it seems like there's a theme building here of uncertainty as we head into the weekend. How do you view the market performance today?
Well, there's definitely two themes here. You got the tech kind of a little bit of air coming out of that balloon here with earnings. I mean, you have Microsoft, Tesla this week. Next week, you look at some of those other behemoths, Amazon, Apple. And it's not unusual to see that volatility around these earnings and through these earnings. But outside of that, a narrative that we've talked about at Blue Line and put in our research for a while that's really has been going under the radar is the U.S.-China tensions. And we're starting to see that uptick a bit here. I think this is something that you really need to keep a pulse on. It could flare up and be worse at any point. And we could see, and we're seeing with the consulate in Houston and now the one in China, there's other rumors around it that are weighing on the market right now. So this is definitely something to keep an eye on. But the market's been overall able to ignore it as it's been boiling for the last month or two due to just the central bank liquidity that's out there. And on top of the fact that the market doesn't think President Trump is going to ramp up that pressure right ahead of the elections, not to derail his stock market rally.
So Amy Selico of Albright Stonebridge Group joined us earlier this hour, and she's been covering China for 30 years. She says she doesn't feel the relationship between the U.S. and China has ever been as weak as is today. Can you tell me specifically in the markets what it is about the deterioration that troubles investors? What are the kinds of headlines they're watching for, and then what parts of the market get impacted by that?
Well, I mean, there's supply chains that we've already seen in the headlines, and that we've seen the supply chains have to be reestablished or audibles per se on those heading in from the pandemic. But the other part is the tariffs, and if we start to see a rollback of what was the phase one trade deal, and if they start reintroducing tariffs, we're right back into the game that we were trading from 2018 and for much 2019. And that's where the fear is. But at the same time, you have a lot of central bank liquidity out there. The Fed's done a lot. Other central banks have done a lot. And that's, helped this recovery from the pandemic. And the question is from here, is there a reason for the market to continue? I'm looking at the equity markets. There's a reason for commodities to continue. And it's pretty ironic to see where everything has come back to now. The S&P, it's getting close to where it actually really did achieve where it broke down in February. The NASDAQ, I mean, tech software has been a huge bellwether for this market, and a lot of them are in better shape than they were before the pandemic, and they were able to do a lot and see demand higher as the work from home and a lot of these companies that had changed what they were doing. So software is a bit different, but there is a little overshadowing some of the chip makers. So we've seen tech though surge through those previous highs, but looking at copper, looking at crude oil, which are really going to be huge for keeping a pulse on global demand as well as what's going on in China. China's demand for crude oil this year was through April and May was really the major reason why it was able to rally. I mean, that obviously, and the fact that OPEC was able to balance supply and demand so well, but crude oil is right back to where that March 6th breakdown was. Copper is right back at a pivotal level of $3. I mean, there's some other tailwinds helping copper with other supply worries with a mine in Chile. But overall, copper's back to that $3. So we're at an inflection point. Can risk assets continue at this pace? And I have to say, as a risk manager, when I'm looking at portfolios, I don't think they can. And I mean, we actually in our research went cautiously bearish on stocks this week, yesterday officially. So I think there's reason to believe some of these risk assets can come in, and it's a good time to do so right ahead of these big tech earnings through next week.
So your advice, you're saying to your clients, has been to lighten your load, to move away from stocks.
Absolutely. I mean, I think at these levels, you don't really want to. I guess the best way to put it is you have to ask yourself, are you a trader or an investor? If you're an investor, you want to just simply be rebalancing your portfolio. I mean, the S&P has climbed, 50% since the lows in March. And I really hope you were, as an investor, buying at that time. We certainly were. Now, the question is, if you're a trader, the market it was showing some signs of exhaustion. The NASDAQ didn't take out its previous high, retested it 2 days ago, and failed at that level. There's definitely reason to believe that you could capitalize on a trading position in going short. And that's what we recommended for our clients.
All right. Good to get your perspective. Thanks a lot, Bill. Happy Friday to you, Bill Baruch, president of Blue Line Futures.